Earnings season started off strong in January, and we'll get the latest on its performance so far from Scott Ladner, Chief Investment Officer at Horizon Investments, who's joining us now. It's good to have you. Thanks for taking the time.
Hey, Lindsay, thanks for having me.
We can talk about earnings throughout January, but I'm not sure if there's anything today also that's standing out to you in terms of like Pfizer, PepsiCo, PayPal, Merck, all reporting earnings today. Anything in particular that jumps out?
I'm not anything that's really particularly interesting or sort of narrative moving. If I'm being honest, I mean, I think we kind of know what we're getting out of earnings so far. It's good but not great. These are solid reports for the most part. Palantir, like overnight was laid out the case for continued AI involvement, but the market's freaking out a little bit about today, about continued sort of equity issuance related to AI investment. So it's kind of a mixed bag a little bit, but nothing really, today or yesterday is really moving the needle from a macro standpoint. About the things that we're really caring about, learning about companies, learning about the consumer and AI and everything else, as we come through this first quarter.
Yeah, when we're talking about AI, like we've got this kind of anthropic effect happening today, where we're seeing a lot of tech companies down because of this new AI tool to help in legal work. I'm not sure if you have any sense of what's going on there, but I know you were talking about AI and how last year was all about building AI capabilities, and the next couple are going to be about diffusing the AI throughout it, like trying to figure out actually how it works. Can you kind of dig into that a little more?
Well, yeah, I mean, look, that's kind of what we're seeing, isn't it? I mean, we're not talking as much about building of data centers and building basically of the infrastructure side, even though that's going to continue to go on and it needs to continue to go on. We still do need some more power infrastructure and everything else to make this really kind of hum. But ultimately, I mean, the thing the market is going to care about and the thing the economy is going to end up caring about more is like, how are we actually using this stuff? How is it being diffused? How are these capabilities being diffused through companies, being diffused through work processes and everything else? And this example today from Anthropic about a potential basically like legal legal GPT essentially is one of those steps. And yes, it is going to disrupt things. We want some creative destruction out of this. The destruction part's not awesome to deal with and look at, but the creative part is how you end up building more productivity into a system, and that is ultimately going to be the promise of AI. But it's going to be it'll be a little bit of a rocky road like we're seeing today.
Let's take a more macro look at the economy now and at the markets for today. You say the economy, this is an economy for 2026 that has some very strong tailwinds. So what are those?
Yeah, look, they start on the fiscal side. We're getting fiscal basically stimulus out of the government in the United States, and we know that coming from the big beautiful bill, the tax breaks for individuals. Those refunds really start hitting in the next week or two. So people are going to start having more money in their pockets to spend. We know they spend it when they got it. But there's other fiscal stimulus that comes in the form of basically private fiscal stimulus, and that's the what I spoke about a few minutes ago, the infrastructure build related to like getting AI into basically into a place where everybody can use it. So the fiscal stimulus side is rather strong. We also have monetary stimulus that people have sort of forgotten about. The Fed did cut rates. Global central banks broadly cut rates over the last year and a half. But it takes some time for those rate cuts to actually make their way into earnings and to make their way into the economy. And it's usually about 12 to 18 months. And we're kind of sitting here at the cusp of that stuff really mattering. And we're starting to see it in earnings. We're starting to see it in small cap earnings, mid cap earnings. We're seeing an inflection higher in some of those numbers like that you would expect to see as the economy accelerates with the impact of the monetary easing from a year and a half ago. So those are the two big ones, and then we could spend all day talking about productivity enhancements with respect to AI and kind of what that can do. But there's just a lot of tailwinds simultaneously hitting the global economy, and that is something that I think but like everybody talks about one or the other, but getting this all together all at the same time, I think is going to end up being pretty powerful.
What about headwinds as we look at 2026? Like, what are the biggest risks you're seeing?
Well, look, I mean, one of those risks really got taken off the table last week. We thought that if Trump really pounded the table on and basically bullying the Fed around and trying to get somebody in there that would do his bidding and get rates sort of artificially lower, that could be a real problem. It'd be a problem not just for the U.S. but for the global economy, because you'd end up with higher rates in the U.S., a weaker currency, just a whole bunch of bad stuff that would sort of trickle through the rest of the global economy. But we didn't get that. We got sort of the anti troublemaker in that seat with Kevin Warsh. So that would probably end up being helpful. But there are a couple other things that we're worried about. Look, the calendar this year in 2026, a midterm year in the United States, is not one that's usually a great year for equity markets. So that is certainly a headwind, at markets right now. And then the other one is some of that geopolitical risk that we're dealing with. The one that you can't call it, but if China were to ever do something out of Taiwan, the military purchases have our attention out of China. The fact that China's economy continues to really struggle and sputter along. Look at the 10-year rate in China. That's really sort of the key barometer to watch. Are they actually getting out of deflation? They're sort of stuck in a deflationary trap right now. If you see that 10-year rate moving up, that's a really good sign. That means that China is getting out of deflation. But while they're stuck in this, look, leaders have started wars for sillier reasons. And if China were to do something in Taiwan, that would obviously be a massive, massive headwind to the global economy.
Got it. Yeah, a lot of geopolitical risks and things to watch throughout the year. And it's only February. In terms of sectors that you say, financials are a big one for you, at least this month.
Yeah, they are. Look, and I think actually the Kevin Warsh appointment helps us out some because we do think he's going to be a big proponent of deregulation. But one of the things we frankly got wrong last year is we thought that Trump too was going to come in and have a big deregulatory policy like he did the first go around. And really, it just was third on his list, and he never, frankly, got to it. The big, beautiful bill and tariffs were basically occupied all the space in the first year of his administration. We do think deregulation is going to come about this year, and financials, and especially the smaller and the mid-cap financials, are really the ones that are going to benefit most from something like that. You combine that with an economy that we think is going to run pretty hot in the United States, and with corporate demand picking up for loans and everything else, and banks being much more willing to lend right now, as we've seen in the SLUD surveys. So we think actually that this is the setup for financials has been pretty good, and we've been involved for a few months. But we think actually this one's got some legs. It could go on for pretty much the rest of this year.
Very interesting. Okay, that's all the time we have, so we'll have to leave it there. But I appreciate you joining us today. Thanks so much.